Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options and plays in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls on their trading phone. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
Well, good morning, everyone. Welcome to the opening playbook for Wednesday, February 11th. Happy Home Day. How's everyone doing today?
Doing good. Let me jump in here real quick because time is of the essence. You guys can close T-Mobile now for about 150% gain. It's right at 200. I mentioned in Telegram, if you're paying attention, we took that trade. The open didn't give us as juicy of a return as it should have, but we are on the dot right now. So 150, 160%, maybe even. I actually closed it and it filled instantly, even though I asked 5 cents more than the mid price. So be aggressive, ask for more money, get that bad boy closed. Great trade on T-Mobile. But anyway, doing good. Sorry, I just wanted to get that. Jim got 100%. Good job, Jim. I gotta give Kane a nod on that because I was thinking about maybe trading a different one, and Kane noticed that the T-Mobile IV was insane. I don't know why. Had a reasonable market maker move expectation, but the IV was monster. So we took that one, and it is a beauty. Let's just take a quick look as we get started here at where we're at, because we had the big pump to about 0.7, I think was about the high here, pushing up to the open, pulled back a little bit. I'm surprised to see, by the way, small caps lag a little bit behind today. I bet they catch up, but small caps just a little bit red there. RSP positive. Bitcoin, of course, lagging behind. Can't really get a run going on Bitcoin. I actually am holding some Bitcoin right now, so I need to get that. So I still don't love Bitcoin in the longer term. By the way, if I refresh, we're already pulling back a little bit further here. I still don't like Bitcoin for the necessarily longer term, but I thought we were going to get a quick leg back up, touch set low 70s again here. Right now, not looking very good. So we'll see if that happens. But I did buy a little Bitcoin for a kind of halfway rally in between. Here's our heat map. You can kind of see what's doing the heavy lifting today. Micron here, Applied Materials, big move on some of these tech stocks. AMD back in the green. Nice to see that. Texas, got a trade on that, so I need a little bigger pop here on Texas Instruments. If you guys are in that one, just need a little more gusto out of TXN the next couple of days. Our friend GE, Graham, I still got that spread open, so it's up 135% from the lotto board.
Oh, nice.
There, closing on Friday. So I think I can get about 170% or so. And then Exxon. I mean, have you guys seen Exxon, the chart? It is unbelievable what ExxonMobil is doing. We actually called this about 4 weeks ago when we said that the rotation is real, energy is real. The big dogs, Exxon, Chevron, you take advantage of them. And then, of course, I basically haven't traded them since I said that. And they're just absolutely ripping. But a lot of good names, Walmart's up there, Apple back in the green. And then at the bottom here, we have a couple that are underperforming. T-Mobile is actually, this is from the 15 minutes ago data. It's actually back up to about break even. So even some of these are a little bit healthier than what we're showing. And then if you look at our sector view, we're pretty neutral across most of the sectors outside of tech and energy that are picking us up. So I don't think anything massive to write home about right now. Got obviously some good positive news. Graham, what do you think of the numbers that came out today?
I mean, they're good numbers. Later this week, we have CPI, which will be a more important number. But the market seemed to like it, although we are fading those gains. Looks like we're going to go ahead and fill that gap. Whether we go back higher from there or not, I don't know. But overall, I'm very, very bullish and excited about this stock market. I think it may be a week till we break to highs. We may see some more chop. But I think once we clip the high number on the SPY, I believe we're going to go 5% before seeing another pullback.
Yeah, I think that we do have a chance to actually ramp through these highs and go. You can see here's the cues. They've really struggled to get any momentum, but because of that rotation that we just talked about with energy, health, basic materials, all of those doing the heavy lifting, SPY is much closer to getting a run. It looked like we might pierce right through the top here. Let's see, what did we get as our high? It had to be pretty darn close to 700. Where was our high today? 697. So 0.5% away from this nice whole number at 700. I mean, like Graham said, I think if we get a close above 700, especially a weekly close this week, I think that sets up for a true ramp higher, some risk on excitement, and I would look for a good ramp. But right now, just kind of filling the gap. We'll see what the market ends up doing. It could battle this for a couple more days, could battle it for a couple more weeks. We are still stuck until, proven otherwise. So just be careful with where we're at. I'm starting to get more optimistic the more that we kind of battle through this level and hold the floor when we head down, but got to be careful. We're not quite there yet. So we'll see if we can build some structure. I'm going to get into, I think, a really interesting topic today, which is more about trade structures and how to plan those and to think about distributions differently. Before I transition into that, let me give you guys the floor because I know you guys have been working on the alpha idea. Why don't you give people a preview of what you kind of have going on there? Because it's definitely unique in the sense that it's not even really about the stock itself most of the time. You want to talk through that a little bit, Graham or Alex or whoever?
Yeah, well, I mean, I can go ahead and start. I know you guys have been following this lotto board stuff. I know you guys have been talking about market inefficiencies, basically, or in the options market on the contracts themselves with the IV. So what's really cool is that one, lotto board is freaking awesome. But very similar thing happens with just regular old contracts, right? So what I've been working on for like a couple months here is, a way to spot option price, um, basically inefficiencies triggered by big secretive order flows in the market. So what's really cool about this is very similar to uh, Lotto, is that you don't actually need big moves. If you can spot which, let me see, is this it? If you can spot which contracts are relatively mispriced for the specific transactions that are coming across the tape here, what will happen is the option rather, can go double digit, triple digit gains just a couple of days. And the stock doesn't have to move really at all. So what I'm really excited about with this software is that normally with long calls, long options, right? We're not doing spreads, we're not doing credit spreads, we're not doing any like iron condors or anything like that. Those are all strategies. Those are more advanced multi-legged strategies are ones where you can win when the stock doesn't really move, right? Typically, normally long puts, long calls, you need the stock to move really, really hard for you to win. But what I've been working on is a way to track the mispricings on individual contracts, combine that with trigger points, trigger events. And then even if the stock, if you find the right ones, even if the stock doesn't really move that much, because these contracts are so mispriced relative to what they should be. Well, we closed out at 37% on Carrier. We closed out like a 50% on Pepsi. And this is what happens on these boring stocks, fun stocks, and everything that runs the gamut in between, but it only took like a couple days. So I think I'm going to be on here a couple of days from now, Thursday or Friday, tomorrow or Friday, talking more about this. But we're also, me and Graham, I'm flying down. I was just in Florida and flying back down to Florida to reveal sort of more of the intricacies of this strategy and how it all works. So I'm excited for that. I hope you all, we do have a sign up link if you want to register for that, just so you get reminders. Make sure you're there on Sunday evening at 7 p.m.
Just posted it.
Cool.
Yeah, and it's really cool. Basically, when you guys can see that implied volatility and that little greenish column to the right, relative to where it's been previously. So Alex is finding these contracts that are relatively very, very cheap for that stock. And when a big order comes in, someone puts a lot of money in those options. What do you think the market makers do? They kind of wake up, and we'll see that IV increase, which increases the price of the option.
Yeah.
Which we can make some good money on that ramp. I'm actually curious, Alex, after you showed me this, he showed me some examples, guys. One was AMD moved 1.7%. I think the options were 140% ROI. And these aren't
Yeah.
spreads. I do spreads a lot of the times. You guys know that. Those have a capped upside, which normally can work out pretty good for us, but these are uncapped. These are basic calls. Overnight, 1% move, paying 140%. He had another one. This one was crazy. I can't remember the ticker, but it was a call option. The stock actually fell slightly the next day, but the options were up 40%.
Maybe Merck.
Yeah, I can't even remember the exact ticker,
Yeah.
but think about that, guys. The stock went flat. It actually sold off about 0.5%, but the call options went up in value. Pretty crazy stuff. We'll show you guys.
So it doesn't have to go the
If you
direction
guys
you want.
have, what's that?
It doesn't even have to go to the direction you want, your call or your put, right? You can still
Yeah.
work out just because of that IV. Well, it's called IV ramp. We'll tell you more about it on Sunday.
Well, this
Yeah.
is something, I mean, I know we're going to get into the other lesson, but this is something that we actually talked about for years being a possibility. When we said the options market is getting so big, people are trading more options and stocks. At some point, there's going to be a break where like there's an option market opportunity that kind of sits separately outside of the stock market. Now, of course, it's still going to be somewhat dependent on the underlying. Don't get me wrong.
Right.
The stock's not going to crash and the option's going to go up, but there's a whole different world. They're pricing options, not just based on where the stock is, but like you're talking about, based on having to account for big orders, having to hedge from a market maker standpoint. So there are opportunities that now do exist in the options market that are literally outside of the stock. So it's kind of a crazy environment. We talked about maybe this would occur back in 2020. We started talking about this when options got crazy. Then especially in 2022 when zero DTE options hit, and now I think we're kind of there. Like these opportunities are existing within the options market itself because of how market makers have to price them almost outside of the stock. So pretty crazy to see that happen. And I'm obviously excited of kind of looking at how you're going to track it down and some of the examples of that literally happening right in front of our eyes.
Hopefully one day we won't even have to look at a chart. It'll just all be on the options chain.
Yeah.
I mean, you're pretty close.
Yeah,
Here
you're pretty
with
close.
this
You're pretty
alpha
close.
flow dashboard, the alpha options, pretty darn close here. If you guys have been enjoying the lotto board, you're going to love this. I'm going to ask the developers, can we steal some pieces of this? Because what you're doing here with the weight of the option, the IV of the option, and how that can push, that can temporarily lift the option prices over 5 days or so.
Yeah.
I'm wondering, hey, can we translate some of this into the lotto board? Now that'll be later this month, but if you guys want in on the action now with some really amazing plays, Alex, again, seeing your track record here is pretty remarkable. Well, tune in Sunday night. We'll drop a link for you guys to sign up. It'll be free to come, free to check it out. We're actually going to do a special free year of access for the first 100 folks who take us up on this experience here with the alpha option. So make sure you guys are signed up. And we'll see you Sunday night to show you more about this. You'll be mind blown when you see how this all works, because again, it's happening behind the scenes in the options market, not necessarily relative to what the stock is doing.
Yeah, absolutely. I'm looking forward to it.
Awesome.
Up, folks.
Awesome. Okay. Well, let's
Can I jump in for a sec?
No, you may not.
Okay.
No, I'm just kidding. Go ahead.
Just wanted to address a couple of things that are bouncing around in the chat. So, for those that were in the T-Mobile trade and are showing a loss, I think you entered something wrong, because I'm not sure how you could be even close to a loss right now. It should be up over 100%.
Yeah, maybe 90% now because it's over 200, but yeah,
Well,
90
the width
to
is pretty
110.
wide, so it kind of depends where you get out. But yeah, it's
Who said they're showing a loss? Did someone say that?
yeah, several people did. Jeffrey said I got in at 60, but Fidelity's showing a minus 140%.
If you got in at 60, set a limit for like 105 right now, exit. You should fill, which would be 80% gain or whatever. Mine filled above the mid price immediately. Jeffrey, Jeffrey, see
There were a couple other people too.
And make sure you're doing a credit on the exit, so pay a debit. Who else? I'll see what it shows right now, because mine filled at
I just looked at it a
117.
minute ago. It was $1.25 to $1.90 a minute, like literally a minute ago.
Yeah, mid price is still over 110, guys. So
Yeah.
you should easily fill for. And I filled over mid, so it's bouncing around. There's not a ton of liquidity there, obviously on T-Mobile, but worst case, you're going to get $1 out of it and make 80% or 75%. Dragon got 115.
Yeah, several people got just above or below $1. So, but there were a couple of people that said they were having an issue. And then the other thing I wanted to mention is that we're not having the issue, but Railway, the platform that we host some of our tools on, like Income Machine and some of the other scanners and stuff, is having an outage. So if you're having an issue with some of the tools in our members area, you shouldn't have any problem with the members area. The members area is up and running. But if you're having a problem with some of the online tools, it's out of our control. They're working on it, and hopefully we'll be back up very quickly.
Okay, yeah. Normally they're pretty quick. And then I saw one question there about getting exercised on SPX. Yeah, you can get exercised on SPX in the sense that they exercise and do the math. They don't give you shares. There's no shares. So maybe we need to be more clear in how we describe that. With SPX, if you have the 6,000 call and the 6,010 call, and it ends up at 6,008, they're going to exercise that, and you're going to get the net $8 of value, but you're not going to get 100 shares of SPX at $6,000 a share. So yes, it's an exercise. It's not an assignment of any shares.
Yeah, that's what I said earlier. Because people were saying they got assigned, and I said you can't get assigned. There's literally no shares to get assigned. You could get it will get exercised, but you won't get assigned.
Right.
But I think it was Caroline or somebody with a C. I'll have to go back. But somebody said that they got a $5,000 assignment on it or whatever, and I'm like, send me a picture of that because that's not supposed to be possible.
There's no shares of SPX. So Linda said, if I'm way in the money, will it just close tomorrow? Well, not tomorrow, but Friday, if you want to leave it, your broker will do an auto exercise. They'll exercise and assign it out, and you'll get the max profit of a debit spread that's fully in the money. So no action items for you to do on a debit spread if you want to just get the max profit and it's well in the money. But if you want to close it, you can use a target. We'll touch on that here in a moment. Any other questions before I jump in? I'm excited about this. This is again a little bit more of a conceptual training today, but those are some of my favorite, just to maybe help you reframe how you think about trading. So I'm excited about this. Interested to hear you guys' feedback, and if this maybe gives you some light bulb moments of more how I think about trading. But before I jump in, let me know if you have any questions there. I think I covered the main ones.
Oh, before you jump into that, Kane, for those that were on Closing Playbook earlier in the week and took Kane's Nike trade on Monday, he's recommending you close that out for profit.
There we go. Cool. And we got Apple yesterday from Kane using the income machine. So that bad boy's looking good already, of course, early into the trade. And then, by the way, the nice thing about today's bump, big enough to slam the target on overnight options, even with a flush here. So that's always nice when we're rung the cash register and we don't care a whole lot about what comes next. Okay, let's get into our training, ladies and gentlemen. By the way, if you are new, this might be a little conceptual, but I think it'll be a great framework for you to think about trading in kind of a more fundamental way, kind of how I think about trading across the board. Let me know if you're new, if this is one of your first times in opening playbook. Just put a yes in the chat or hello, I'm new in the chat or something so that I can see you and recognize you, because today's session, again, it won't necessarily be tactical in terms of here's a trade idea, but I think it'll give you a good frame of reference for how I think about trading and really overcoming what I think is probably the biggest challenge that most regular people have in trading. Okay, hey, Connie, Storm, MJM, BK, Michael, Marion, Crystal, hello, Greg, Dave D, hey. All right, Susie, hello. Well, thank you guys for jumping on. Always love having our new people. Hey, Mikey, Chris, hello. This, I think, will be a good framework for you, and I'd love your feedback here and everyone else's, of course, as we go through this. So let's jump in. The idea here of today's lesson is to think about the market and think about your trades in terms of distributions and not predictions. And really the idea of why I stopped trying to be exactly right all the time. So, I get this question all the time, whether it's from you guys or it's from a buddy at the golf course. Oh, you're in stocks and options. Normally the next question I get is, hey, do you think Apple is going up this week? Right? It's kind of binary, predictive based. And honestly, I usually do have a bias on the direction of a particular stock, anyone that I care about anyway. But the key here is that the bias is a starting point. It's not the trade. I'm actually going to just throw this in the chat, as simple as it is, because I think this is really part of the key here. When you have a bias on a trade or a stock, that's the starting point to think about an opportunity. It is not the trade. The real question that I'm going to ask is, given what I think is likely, what ROI can I get for being right? And then how much room do I have if I'm wrong. And I've been talking about the income machine a lot lately because I think it's the perfect tool for these kind of choppy markets. I'll talk about that a little bit later. If you guys aren't using the income machine, that's what makes the income machine so powerful. It's answering this question in real time all the time. And so this is a very different way to think about a trade. Now, the way that you can kind of simplify this is you can think about it in 5 outcomes of a trade. Just to kind of narrow this down and make it simple, here are 5 outcomes. Every time you get a stock, every time you place a trade, it can go up a lot, it can go up a little, it can go sideways, it can go down a little, or it could go down a lot, right? 5, just to generalize it, those are the 5 outcomes that you would expect for the underlying stock every time you get into a trade. Now, most traders pick one of those and they build their entire trade around that one idea. What I try to do is think about all of them at once. Now, it doesn't mean I'm perfect. It doesn't mean I get every scenario plotted out exactly right, but I try to think about all those scenarios in the context of each trade. So the question is not just will I be right on the outcome, but it's within my scope of expectations, how much do I get paid for being right? And how much room for error do I have when I'm wrong? Okay, I'm just going to pop that in the chat for you as well. If you want to take notes or write it down on a sticky note, there you go. Okay, within my scope of expectations, how do I get paid for being right? And how much room for error do I have when I am wrong? And that's really what I mean when I say distribution thinking. So prediction thinking would be, I think it's going up, let me buy something. Distribution thinking would be, I have a bullish bias. What ROI am I going to get for this? What happens if I'm wrong? What structure captures those different scenarios? One is picking a direction. The other is really mapping a territory, right? So let me show you what this actually looks like in as simple of terms as we can do within a conceptual idea like this. Okay, I have an expectation, I think, hey, I'm right. If I'm right, the stock's going to go up. I have a margin for error. Okay, what kind of happens if it goes sideways or comes down? Really, the question there is how far I can be wrong and still be okay. And then, of course, I have the worst case. I have the defined, capped, accepted loss before I enter. I can see Dave giggling on the screen. Dave, are you in the chat that you're giggling about right now?
I am, sorry.
Okay, all right. Make sure Dave's not giggling at my charts.
No.
Okay. Margin for error would be how far can I still be okay? Worst case is kind of the defined, what is the worst case that I'm okay with? And of course, you do have to be okay with it. That's critical. So basically, you're looking at, here's my expectation zone. This is what I think is most likely to happen. This is the bias. But you're also looking at the margin zone. How far can things go wrong before I actually start losing money? The bigger this zone, the better. By the way, that margin zone, I think, is the most important thing. Hashtag income machine, right? That margin for error. And the worst case, when it all goes wrong, the defined, capped, and accepted risk of the trade before you click any buy buttons or sell buttons or combination buttons. So the trade is going to be the relationship between those 3 zones, not just a bet on one of them. And here's where it gets really interesting. Once you start thinking in distributions, the right trade structure actually becomes a lot more obvious. Let me ask you this question. Give me a yes in the chat. If you hear us talk about a trade, we're going to do a butterfly or a calendar, or we're going to do a debit spread or a credit spread, and you really don't know why we're picking one structure one day and a different structure the other day, why we might do a call or put this case, and you just give me a yes if you're like, hey, I get it and I follow some of the trades, but I don't really know why we're picking one structure one day, one structure for a different trade, why this one fits here and that one fits there. Okay. Well, okay, apparently 3 people have thought that before. The reason is probably because you're not yet fully comfortable kind of mapping out the territory and thinking what structure actually fits that territory and those potential outcomes, right? So, for example, once you start thinking, okay, I'm aggressively bullish, I'm pretty much okay to take a loss if I'm wrong, well, then you might have a jump trade or an elite trade or a call option. you kind of expecting, listen, if I'm wrong about my very bullish bias, I'm going to lose money, but I'm going to make a lot of money if I'm right. Well, that becomes more obvious. What about if I'm more mildly bullish? Well, now we might be talking about like an income machine trade, or maybe we're bullish enough to do a wrap order. What if we're neutral? We like the stock, it feels stable, we're not super aggressively bullish, but on a neutral trade where we think the IV is too high, we might do a calendar or a butterfly. Or maybe we're aggressively bullish or aggressively bearish, but it's just highly volatile. Hey, I like Tesla right now, but I also know Tesla could drop 10% at any given time. Well, now we're talking about a two-way trade or maybe a profit pair trade. Your expectation is going to determine the structure. That structure is going to determine the distribution, how much margin for error you have and all that sort of stuff. And then you're basically going to fit that together into a scenario. So it might be something like this. Again, I'm overgeneralizing here for the sake of making it make sense. I'm trying to be general, but still make it be specific enough that it's helpful. A call option might be if a stock goes up 1% right away, you can make 30%. But if it goes up a lot, you're going to make big wins. Everything else, you're going to start losing money. This says stock dips 1% to 2%, down 70%. That would be right away. If it's later in the trade, you're going to be down 100%, obviously. And so, something like this. A wrap order is like, okay, if it goes sideways, you're kind of right in between strikes. You're at break even. If it goes up at all, 100%. If it goes down, though, you're also going to lose 100%. That's more your wrap order. Your income machine or your defensive trade is going to be, hey, I'm going for 20, 25, 30%. If it goes up, I'm going to make it. If it goes sideways, I'm going to make it. Even if it goes down, I'm going to make it. Even if it goes down a lot, I'm probably going to break even, make a small profit, small loss. And it's really only going to be if I lose a lot that trade goes down. Let me try to move my head out of the way a little bit more here for you. Is that better, Lynn? My less blocking that butterfly example now. So the income machine obviously has very different scenarios than something like a wrap order, because the ROI is not the same, but the conditions for the trade are also not the same as well. And then we have something like a butterfly, which is neutral, right? If the stock goes sideways, that's actually our max profit potential, assuming the butterfly is at the current prices, right? And then we also have the stock goes up a little bit, good. Stock goes down a little bit, good. But once it starts moving a lot, now we're going to start losing money on the butterfly on either direction. So again, a very different distribution of circumstances depending on the type of trade that you take. This is why you could easily consider 3, 4, 5 different types of trades on the same ticker, just depending on what you expect to happen, right? You're looking at Apple, or let's go to T-Mobile. We're looking at T-Mobile for earnings yesterday, right? Well, we expected it to be more neutral, so we did a calendar. If we expected it to be really bullish, maybe we would have done a vertical. If we expect to be really bearish, maybe we've done a put vertical, or could have done a two-way trade with a hedge. If we expected it just to be easily move outside the market maker move, we would have done a two-way trade. So different trades based on different expectations. Here's kind of how I would break it down. Your bias is what you think is going to happen. Your distribution is the kind of the path and the territory within that you could reasonably expect. The structure is the trade, and then the execute is you're going to set up, pay the price you want, and set up an exit plan. And we can make this whole concept even more powerful. Linda, I'm not sure what you're asking there. The income machine will certainly show the cushion, yes. But we can make these distributions and these scenarios even more powerful. Here's the big aha moment that I had a couple of years ago that changed my trading forever. Because all of those outcomes ask the question, where does price finish? Right? All of these outcomes right here, they ask the question, where is price going to end up? With a GTC target, we can add a question, which is, does price ever visit my target? Okay, and this becomes really powerful. I mean, this really flips the whole game on its head. let me draw this out for you a little bit because it really does change the game here. So let's think about it like this, where we have a stock that can do different things and we have a wrap order, right? Now, the wrap order is saying, listen, if it goes up a little bit, I make money. If it goes up a lot, I make money. If it finishes down, I make money. If it finishes lower, I lose money. If it finishes down 1%, I lose money. If it's in the middle, I'm going to make basically nothing, small gain or small loss. Okay. But these are all based on where that stock is going to finish at the expiration. So expiration becomes the dictator of all these ROIs on a wrap order. What we can do is make this a little more dynamic with a target by saying, even if it goes up early in the trade but finishes lower, or it goes down early in the trade but finishes up, I still want to make money anytime it's in this profitable zone, not just when it expires. And so you can create a situation like this where you still have your line in the sand here, and this is completely based on where price is going to finish, but you have this zone up here where you can make money even when you're wrong. George and Linda, you're asking questions specifically about the income machine, which we can talk about in a minute. But what you're on right now is just our opening playbook session. This is just our free daily session. So what I'm talking about today, while it would complement income machine, is actually not about the income machine. I'm just giving a more conceptual lesson today about how I think through trades using what I would call a distribution approach. So this would not just apply to income machine. This would apply to all my strategies, everything that I do. This is just our free session today. For income machine specific, we can talk about that, but you also have the master classes, the FAQ, things like that. So two separate scenarios. Again, you're welcome to ask income machine questions in here. I don't mean that you're not welcome to do that. I just mean today's lesson is not necessarily about income machine. This is our free opening playbook session that's about anything and everything, and you can ask questions about anything you want. So this is just a more general idea that I'm talking through. And the idea here that I'm specifically talking about right now is when we use targets. We change the scope of where a price is going to expire or finish to does it ever get into a profitable position? And that gives us even more possibilities. So in distribution terms, the GTC, that exit, that limit order, we would call it a profit target or a limit order, it turns your distribution from a single snapshot, where's price going to end up, to more of a moving window. You get more opportunities. Okay, so you're no longer asking where price ends up. You're asking, is it ever good enough for the ROI to make sense for me to get out of the trade? Which is definitely a different question. Okay, so I've said this before. Most of us equate a wrong outcome with a wrong input. Okay, that's how our brains are wired to think. I got a wrong outcome, therefore I put in some kind of wrong input. I stood up on the tee, I hit my driver, I blocked it out of bounds. What did I do wrong on the input? Well, maybe I was late on my downswing, or I opened the face, or whatever the case might be. Wrong input, wrong output. But in trading, it doesn't necessarily work that way. In distribution thinking, a loss isn't a mistake. It is one of the known scenarios playing out. You accounted for it, your max loss was defined, and across many trades, the favorable scenarios should show up more often. Okay? I'm going to pop this in the chat too. I know I'm being annoying popping things in the chat, but I just want you guys to kind of grasp this, because this is just as important as the trade concept is the mental concept that when you're wrong, meaning you lose a trade, that doesn't mean something was broken about the trade that you put on. It means one of the outcomes that you expect to happen from time to time did happen, and you're okay with that within the distribution of expected outcomes. Okay? So let's revisit this question. But Nate, where do you think the market is going? Well, like I said, I have opinions about that. I share them. They're usually my starting point for a trade discussion. But my opinion about direction is the least important part of my trading. And yes, I mean that sincerely. My opinion about direction is the least important part of my trading. The structure and distribution do most of the heavy lifting. So if you gave me a stock and said, I have no idea where this is going, I could still usually find a trade worth taking. Why? Well, because that's the least important part. The more important part are how do we map out those scenarios and what the profitable outcomes versus the negative outcomes actually look like. Because again, the trade isn't the prediction, the trade is the structure that fits the range of possible outcomes. Now, let's zoom out here a little bit. Once you think about this, it starts to apply to your whole portfolio of trading ideas. Okay? You start thinking, trade structures apply to markets. Markets bearish, it's crashing. Okay, well, I'm probably doing 2, or I could put profit pairs here. Profit pairs would fit into this category. It's somewhere between choppy and stable and maybe starting to trend. Okay, automated options, my investing 2.0 portfolio, overnight options. We're trending to ripping. Okay, that's going to be more jump trades. Of course, investing 2.0 is still going to do great in that environment, et cetera, et cetera. Okay, so once you start thinking about this, and by the way, Income Machine fits all of these. So I would just say Income Machine, kind of everything, because it's automatically going to be dynamic based on the markets because of the options pricing itself. But you can start to apply structures to scenarios once it makes sense to you. And when you run multiple strategies, you're not diversifying. I kind of hate the word diversifying. I think it's a bad word in most cases. I don't really care about diversification in the sense that, hey, I have some staples, I have some energy, I have some tech. What I care about is, am I covering the different distributions of the market with positive expectancy? And that is really the idea of running multiple strategies. When people ask me, Nate, why do you trade 10 strategies at once? You're talking about Income Machine one day and overnight options the other day and jump trades. Why are you doing all of these different things all at the same time? This is your answer. Because I want to cover all of the different distributions of the market with positive expectancies and then kind of round them out and blend them together over time. That's the point. That when people say, like, what's the benefit of becoming an HQ member and trading everything you do? Well, it's partly that you get, the training and the access and all of that kind of stuff. But it's a lot more practical than that. It's this. If you blend the strategies together, my expectation is that you have positive expectancy across all the different distributions, and that will more effectively blend your profit curve up over time. That's really the whole idea. Okay, so here is the big takeaway, and then we can jump into some Q&A, and then I'll revisit some of the Income Machine questions in a moment if you just hang tight with me. And then anyone who's not trading Income Machine, we can play that presentation one more time. I've been playing it a lot the last couple of days just because I think it's so important for the current markets. But if you just hang tight, we can do that one more time as well. But let's kind of talk about the takeaway, and then maybe we can actually look at some scenarios as well. Stop asking, is this going up? Yes or no binary. Start asking, given my bias, what ROI can I get for being right? And how much room do I have if I'm wrong? And then pick the structure that fits that scenario, that fits your bias and gives you the right ROI for that bias. Before every trade, you can think about it like this. What's my bias and expectation zone? What ROI does this offer set up if I'm right? How much can I be wrong and still be okay? What structure then fits that distribution? And most importantly, is my worst case scenario defined and acceptable? Okay, so that's really the core kind of process to ask yourself as we think about setting up trades. And let me switch here. We can kind of do this in practice here as well. But before I shift fully, because I'm going to show you kind of how we could think about that from an actual distribution standpoint. Oh, nice. My Tesla calendar's up. Okay. Give me any questions you have while I'm doing this, and we can also cover those. And then I'll talk about it a little bit more specifically as it relates to the income machine. So while I'm doing that, okay, let's look at Apple. Let's look at Apple. Where'd my chart go? Let me find my chart, and then we will look at Apple. By the way, Dave, I am popping up a couple different screens, so if there are questions I'm missing, you might have to throw them my way while I'm not fully paying attention to that as I'm trying to set up a couple different screens here. But
All right.
Let's start with Apple. Okay. I personally think Apple is really, really nicely set up. I said this is one of the best structured trades I've ever seen when it came. I mean, you really don't get a better structure than what we got on Apple here. With this pop down, came right into this 250 zone, which has been a key zone before. Immediately, just a nice clean couple bars down, move back up on the weekly chart. I don't know if it hits the fib level too. Let's see. Yep, right on the dot. I didn't even know that going in. I promise I just drew these lines for the first time. Literally
For sure.
on the dot, which you can kind of visually tell would be close. But I mean, you don't get a lot more perfect than this. The right time to take this trade was at 260 at the end of this week, but I still think it's probably headed to new highs. But this is a good example because it's not. If we took the trade here, we could set up a crazy nice ROI trade with a move up to here. But now we're late. Being late gives us more confirmation that it's headed that way, but it takes away a lot of the ROI. So we're not going to structure the trade the same way that we would here. What we might do instead is structure the trade that it's going to probably finish somewhere in this region in the next 4 to 6 weeks, which is a different scenario than I think it's going to go up in the next 3 to 5 weeks, for example. So different kind of structure on the trade that we're taking now versus the one that you might have taken 2 weeks ago or 1 week ago even. So let's then ask the question, what kind of trade will we take? Well, we could take a reverse iron condor. We could say, hey, I think it's definitely going to go above 275, which it already is, but I think it's probably going to at least settle below 290 for a period of time. We could build a box here with an iron condor. We could do the same kind of thing with like a butterfly trade. We could just make a regular bias. I think it's going over 280 next week, let's say, and we can kind of compare those scenarios and the ROIs to the potential outcomes. So let's actually do that. Let's go through the exercise real quick. I'll try to do this quickly because I do want to talk about income machine a little bit more in depth, but let's try to just get an idea here. So let's build a long debit spread. Okay. We're going to ask the question, if Apple is above 280 next week, what can we make on that trade? Okay.
We're still on T-Mobile. There you go.
Yeah, those calls would not have been very good for T-Mobile. Okay. Here we go. Why did that move so far past where I wanted it to go? There we go. Okay. 275, 280. If you guys want to write these numbers down, we can kind of compare them. This trade would cost around 288 with about $211 of potential profit. So less than 100%. The reason is why? Because we're a little bit closer to 280 right now than we are to 275. So we're paying for that. Expiration would be about 9 days. but it only needs to go about 1% in order to hit this trade. Okay? Everyone see this? About
I got it written down.
yeah. About what does that ROI end up being? 80%?
I just took the number. I'll tell you in a second.
Oh, 73%. Duh, right there. 73%. Okay, 73%. We'll make 73% if we're right. We'll have a tiny bit of cushion here if it goes down to minimize our loss or break even, because anything above 275 is going to give us some value, but then anything below that is going to lose 100%. Okay? So that's the call spread. Let's get a little more interesting and do a iron condor. In this case, let's use the same expiration, and actually let's also use the same 280 level and say that it has to go above 280 for us to be right. Okay. Oh, wait. It wants to do it as a credit, but I want to do it as a debit.
You want to reverse iron condor?
No, I want a regular condor, but I just want to do it as a debit.
Oh.
All right. Okay, and that is 279. Why is it not letting me do it as a debit?
Because you're selling the higher one. Higher strike. You need to sell the lower strike for it to
Yeah,
be
but wait, hold on. No, see, that's also flipping it as a negative. Hold on. Hold on. I want to do. Oh, you know why? You know why? It's because
the option pricing.
the pricing is so high that it's basically saying if you hit in these areas, you're not going to make any money anyway. But I should have a $5 max even on the upside, unless that pricing is way off. Let's see, 279. All right, let me do it. I'll do it as a credit and see if it builds it more accurately. Let's do it as a credit and use the same 280 level. See if that gives us. And then okay. So this one would basically be I'm going to build a box between 280 and 300 on Apple and see if it stays in that box in this time span. Anyone see the immediate problem that I spot with this trade? Even though I don't mind the trade, I think 280 and 300 is a great zone. Anyone's immediately, when we talk about distributions and ROI potential, does anyone see the immediate challenge with this particular trade compared to the one we just did? Because remember, we're going to compare side by side. I'll give you guys a minute in the chat. Let me know if you see what I see. Immediately jumps out to me as why I probably would not take this trade. Just give you guys a minute. John G says chance of profit is low. It's not necessarily that. It's giving 51%. I think that's undervalued a little bit. The issue to me here is that our profit potential went up from 73% to 96%, which is a little bit of a jump, but we're adding an entire new condition for the trade in order to get that bump in ROI. We're basically saying, hey, before it could go anywhere. As long as it got above 280, it could go to the moon. We didn't care. And we could get 73% on any other side of that line. Now we're adding this whole other condition where we're capped and we're not getting way more value out of it. Okay. So that to me is the big issue. Now we could remedy that by giving ourselves a little bit smaller box here. okay, and see what it prices that at. There's no way that credits, right? Let's see if it updates that credit. Let me build it in Thinkorswim too, just to make sure our numbers are. I don't want to just go off of option strategy. It should be pretty close. On the February 20th, let me just grab it right here in option strat, the 275 and 280 versus the 295 and the 290. Yeah, okay, that's actually not far off. That's maybe a little more credit than that, but not much. So in my mind, that's horrible. That extra ROI for that trade of putting the limit on that trade is just not good at all. Okay, so we can this is February 20th on both. So we can kind of roll that out from a scenario basis. But I kind of like a slightly bullish neutral scenario here. So we could compare that to the calendar. But instead of doing a fully neutral calendar, we could go up here because we think it's going to go up in the next week or two, 9 days of expiration, and we could build our calendar more like 287 or 285. Let's call it 285. That'd be about a 2% move. So instead of at the 280, we could build this at the 285. Okay, and notice this is a little more attractive. The reason it's a little more attractive is because we have a lot more value early in the trade, 13th, 14th, especially once we get into over the weekend, 16th, 17th here, a lot more value in the trade here. And if we want to hold it and try to pin price right at that level, there's a lot more ROI to be had there. Okay, so it's showing that our break even here is going to be somewhere around 292 or lower to 278, which is similar to that iron condor, but with more ROI and more ROI early and less of a loss if we're right outside the boundaries. All right, so do you guys see how this butterfly, I'm calling it butterfly, this calendar's trade by picking the same level with a similar distribution gives us way better outcomes? Everyone see that? We're getting higher ROI in the middle. We're getting earlier ROI, assume. Now, again, the volatility might come down a little bit, so it might look a little closer to this. But still, getting more ROI in the middle. And we're actually getting less of a loss as it moves past these conditions. So this is a great example of we took an idea on Apple and we said, hey, we like the idea, but which structure best fits the outcomes? Because let's say that Apple over the next week pops up to here, settles back down to here. We want that to be money. Let's say it does nothing. Well, we would like that to at least be some money or a small loss. And let's say it overperforms and gets up to 295. Well, we don't want to lose our shirt on 295. We were right about Apple going up. And so we're mapping out those distributions. And you can see here, the calendar looks pretty good. Let's do a butterfly. Let's do, here we go, those same numbers and see what the butterfly looks. Same numbers, same expiration. We're just going to drag these up a little bit because we want some more money on the upside. Okay, that's a little too, oh, sorry, I did 290. Well, we want 285, not 295. I was wondering, I was like, wow, that's pretty aggressive. 290, okay. Here you can see, this is the butterfly. If we can get really close, our ROI is maximized, 300%, 200% maximum ROI. And we do have some early ROI potential here, but our zone does narrow. We basically need in between 288 and 283 to really be significantly in the money. And even if volatility goes down, we're still going to be in good shape there, which is nice. If volatility goes up, we're still going to be okay. So the butterfly is going to be a lot more resistant to a volatility crunch on Apple over the weekend. So 3 or 4 different scenarios. I think we just did 4 different scenarios.
We did. I can post it if you want.
4 different. Yeah, you want to post them? Do you have the ROI numbers on each? Oh, what a legend. Can we give Dave a round of applause, everyone in the chat? Give Dave a round. I would never have given you this if it was just me. I would have just left you abandoned. But Dave actually mapped it out there for all those different scenarios. Now, I personally think it's between the calendar spread and the butterfly in terms of which structure fits us best, because we have really nice ROI and early ROI on the butterfly, but a maximum loss is going to be a lot easier versus the calendar, a little less ROI, but a little more range and lower downside as it moves past those edges. Okay, so I'm going to do one of each, and then we can track these over the next week. Not one of each. I'm going to do one butterfly and calendar, not one of all 4, just to be clear. I'm going to do the calendar, and I'm going to do the butterfly, and then we can track these together and see, hey, did we choose a good one? Did the dispersion and the distributions that we talked about, were they accurate? And did the trade perform how we expected? Okay, so the butterfly, I'm going to do the calls, 280, 285, 290 on the calls. It's saying 104 debit. Let me see if that's about right. 285, 290. Yep, that's about right. You can actually get in a little bit better than that. So I'm getting in here for about 94 cents, it looks like. Let's see. I'll try at 93, see if we get filled. Okay, and while that's filling...
That's the butterfly?
That's the butterfly. I did the 280, 285, 290, 94
Yep.
cents. Looks like the mid price. I'll see if I can get a good fill on that. And while that's filling, let me go to our calendar. We did the 285s on the calendar too, right?
Yeah.
Okay, I'm going to do the puts on that.
Yeah.
And that should be about 65 cents. What number did
No,
you
it
have
was
on that?
$1.20-ish.
This February.
February 20 and 27.
Yep, that's why. Because it defaulted me back to my previous expiration dates. Thank you. I would have definitely taken the wrong expiration date. 20 and 27 we did?
Yeah, 20 and 27 at 285.
Okay. Thank
Should
you.
be around $1.20. It was jumping around a little bit.
Thank you, thank you, thank you. 285s there. $1.15 is what I'm getting right now.
Harry, you can, if you take the debit spread training that's in that $1 members area that I have pinned to the top of the chat, you'll get a full explanation. But in short, your spreads are almost never going to be worth their full potential value until right at expiration, because there's still time for it to move. It would have to be way, way, way above the goal, the sell strike, for it to really be worth full value well before expiration. So there's time decay and all that. It's all in the training in the dollar members area.
Okay, Dave, I got filled at 113 on the calendar and 95 on the butterfly.
All right, cool.
There you go.
113?
113 and 95.
Yep.
Okay, now the other thing that we can do, which is what the trade we did yesterday, that's why I didn't replace it here, is we can really expand the distribution. That's what the income machine is all designed to do. So if you do something like the verticals that we would use for the income machine, you have these distributions here, and your paths are going to be pretty good under like an at the money wrap order, something like that. What we do with the income machine is we do something like this. Okay, where in this call, how do I need to change the price of my call. Let's see, can I do that? Nope. There we go. Oh, dang it. That's not right either. Sorry. I just want to make this more accurate so I can show you what I mean in relative terms. But math is hard. There you go. So what we do with the income machine is we give away some of our ROI. Okay. Notice how this went from, you could make 80% if you pin price or 97% to now 28, 29%. Everyone see that? The ROI is what we're sacrificing. But look at the distribution. The distribution is what we're maximizing. So when you open this up to a huge range on Apple, even of 6% on the stock, all of these outcomes are winners. So this is the income machine focus. We're not leveraging ROI as our key metric, although certainly it's one of the key metrics because it has to be a certain amount of ROI relative to the cushion that we're getting. But what we're trying to do is we're trying to maximize the distributions. Let me give you one example of what I mean by that. So, oh, hold on, wrong thing there. Let me see. Here we go. So when I showed you this 5 outcomes earlier, a lot of people are going to make money if this one hits, right? That's where they're going to make money. If the stock goes up a lot, everything else is losers. And what I just showed you some ways where actually we can make money here, we can make money here, and we might like break even here. Okay. You could set up a trade more like this. What the income machine is doing is saying, actually, I'm going to make money here. 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 And I might even make a little money if it goes down a good bit. And then I'll lose money if it really craters on me. So it's more of a distribution focus than an ROI focus, where we just turn so many scenarios into winning trades. Okay. Does that make sense? Just give me a yes in the chat. Because hopefully, if you guys, whether you've been trading income machine already or not, this kind of gives you a conceptual framework that now we're bolting on top, where you can kind of see how that looks in practice. So when I say I like the income machine for all scenarios, it's because when you account for options pricing, these scenarios get better and high volatility. They get not as big and low volatility, but then stocks aren't moving as much. They're completely dynamic for the market conditions that you're facing, and they're always optimizing for the most scenarios, resulting in a win. Doesn't mean you win every time. You guys know the drill. It's not what I'm saying, but that's really the magic of income machine, is that it takes a, hey, I hope I'm right and I make a lot of money scenario into give me the most distributions that could happen that can result in a win. Just like the Apple's up 2%. Pretty small move. Our trade is now sitting at like a 93% probability of success according to the market maker move, right? Even though it's a small move, because those distributions are now even more advantageous. The cushion is by effect even larger. That's what we're going for. Chris, option X, exactly the same concept, except for the metrics are just shifted a little bit, right? With option X, ROI does play a little bit higher weighted role in the algorithm than the distribution. Still very distribution focused, but now we give ROI a little more access. And then the big thing with option X is that it literally is option X focused, option market focus. We're not even starting with the stock and then building a trade like we just did with Apple. We're starting with the option market. Where are the juiciest options? And then do they fit the stock with enough cushion and relative ROI for us to be an opportunity? So that's the scenario. Mitch, it does do that. There will be trades. You can narrow it down, but it typically will find $5 and $10 spreads because of exactly what we just talked about. That should be a little bit of a light bulb moment for you guys always saying, why is income machine always like widening and finding $5 spreads and $10 spreads? Because of exactly what we just talked about. Because it changes that distribution table and creates more scenarios where you lose less and win at the end of the trade. That's the entire reason that it builds those spreads custom the way that most people wouldn't build a spread, is because it's doing it based on that distribution table. So that that literally is what it's doing. Okay, hopefully, guys, this was valuable. I hope this kind of conceptual framework makes sense. The distribution idea, how to think about the trade, some of those questions to ask. Obviously, if you want to trade with the income machine, it does all of that heavy lifting for you. You're not doing anything. It's just mapping that out. I recommend that every single one of you use the income machine. I think it's the best tool out there. I'm biased. I built it, but I think it really is an incredible tool. If you guys are not using it, I've played the presentation a couple times the last couple days, but I know there's still probably 100 of you in here who aren't using it. Watch the presentation. Try it today. I mean, there's really no reason that you shouldn't be using the income machine. At least give it a try and let me know what you think and see if you're getting in some of those better, higher probability trades. And if not, then you didn't pay anything for it, so you really didn't lose out. And you can complain to me. You can blow me up in opening playbook and say, Nate, you're a loser. I lost money on your trade. It gives you lots of opportunities. So hopefully you guys will take advantage of the income machine starting today. If you're not already, Dave, if you want to click play on that presentation. Thanks again, guys, and hope you have a great rest of your day.
The first income tool of its kind. It's designed to give you different choices, different options, all done for you, and that way you can find the one that you find most appealing. And today, by the end of the class, you can unlock the newest income opportunity today. No payment necessary, nothing like that. Like Nate said, no strings attached. Now, the trades expressed today are based on signals that the income machine generated with the benefit of hindsight. And while today's guest, Nate, has been using this tool with great success in his own trades, including a 93.3% win rate as of this last week, with a 4.92 profit factor on live signals. Well, you guys know that that's great, but there's going to be winners, there's going to be losers, so let's be smart here. Now, every example today is based on $2,500 unless otherwise stated. However, this is important. You don't need $2,500 to get started. A lot of these picks are as cheap as $100, $200. Some are even like $50. Now, the stories that we're going to share today were from real people who submitted their story for us to showcase. We did not meet with anyone one-on-one. We did not advise anyone's financial situation. We don't do that. We're publishers, not financial advisors. Now, each person makes their own decision when it comes to trading. So trade at your own risk, and you can see the terms on our homepage for more information.
And by the way, thank you for all those incredible stories you guys sent in.
We ended up with over 1,400. We asked for 500. We got over 1,400. Now, guys, just to say this one more time, there's no black box miracle system. There's going to be winners. There's going to be losers. So be smart. Make sure that you are trading risk appropriately, and then look to grow an account over time.
Sorry, Graham, my keyboard is whacking.
All good. Hi, I'm Graham Lindman, and I'm your host for the big reveal of what we're calling the income machine. And today, I want to invite you to get your hands on the income machine for free, and I really mean free. It's all part of a brand new initiative designed to help everyday traders target extra income from the stock market. Now, I'm talking about income opportunities that could be worth $250, $500, or $1,000 each week, all based on your own risk appetite and your own investing goals. You see, over the last few weeks, I've been privately meeting with trading superstar Nate Tucci, who is quickly becoming one of the most popular traders under the age of 40. Now, after using his aggressive income approach to publicly grow an account from $10,000 to $50,000 in about 4 months, and then quietly generating over $100,000 in his slow and steady income portfolio last year alone, well, now Nate has set out on a mission unlike anything we've ever done before. It's a mission to solve one problem that no one else in the trading world has. You see, most income methods out there box you into a single approach. They're either built for the ultra-conservative retiree, or they're designed for the risk-hungry investor who's looking to double their money. There's no flexibility, no middle ground, and no way to adjust the opportunity based on your desired approach, or even the ability to shift your risk appetite based on market conditions or other factors. But what if there was an income system that could do more? I'm talking about an income system that could help folks target $250, $500, or even $1,000, depending on what you are most comfortable with. Well, as you'll see today, that's exactly what the income machine was programmed to do. It's the first income tool of its kind, designed to help you dial up or dial down how aggressive you want to be with just a few clicks. Every day it uses a proprietary formula that scans the entire market, identifies the strongest setups, and then breaks it down into 3 specific trade ideas so that you can choose the route you want to go. The conservative approach, that's for folks wanting to shoot for consistent wins and limited risk, targeting right around 250 per trade. Or the balanced approach for folks wanting to target a little more upside, shooting for around $500 per trade. And then there's the aggressive approach. That's for those chasing $1,000 plus payouts with smart, calculated trade setups. Now, regardless of which approach fits you best, you'll get exactly what you need to act with confidence. You'll get the exact stock and options to trade. You'll get the exact hold time. You'll see the break-even price, the expected income potential, and even the calculated odds of success, all done for you. No guesswork, no noise, just a direct income signal where you have the power to pick the opportunity that you like the best. So whether you're in retirement, scaling up a side hustle, or just getting serious about finding new ways to help build monthly income, well, the income machine lets you pick your path. All you have to do is press go. And today we're going to give you a chance to try it out for free. You won't have to pay a dime, not even a credit card required. That way, by the time this class is over, you'll be able to start using it right away to access the top income opportunities already selected for today, targeting the next $250, $500, or even $1,000 payout right from your standard brokerage account. So Nate, it's great to have you on today. Show us everything.
All right. Well, hey, everyone. It is amazing to be here today, and I can't wait to give you the keys to this all new, fully automated income machine over the next couple minutes. A tool that can allow us to target, $250, $500, $1,000, sometimes even more, using an optimized income opportunity every day with just a couple clicks of the mouse on the tool. It's all thanks to an underlying market phenomenon that I've been using in my top income strategies. Phenomenon that's helped me with, real-time win rates like 77.7% on overnight income, 80.5% on 2A income options. Those are, a great income strategy for people, and even 100% on the weekend income strategy. So obviously, income, this is kind of what I do. These are all on live published trades. But now with the income machine, I've programmed something even more powerful all in one place to help us automatically source some of the best income opportunities each and every week, where you have the power to pick the approach that fits you best.